Episode of Market Call is made possible by Robinhood. Try out Robinhood Legend, the all-new free desktop trading platform designed for sophisticated traders like you. While there is no cost to use the Legend platform, there are other fees associated with your brokerage account. See the Robinhood financial fee schedule for more information. Glorious day on this Tuesday, August 26, 11 a.m. on the East Coast, 8 a.m. on the West Coast. And as I've mentioned 100 times, I don't know what time it is in the middle of the country, but it's 8 time. Nathan Guy Adami here. Apparently, the great Vincent Daniel is floating around in there with the great Danny Moses. Those of Big Short fame. They're going to drop a podcast later today. Hello, Dan.
I'm doing great. I got to hang out with Vincent for a few minutes there, and of Big Short fame, as you like to say.
Danny, it's become one of those things. It's like you almost have to say it after the name.
You know who says it? CNBC says it, which I love when the guys are on of Big Short fame. Steve Eisman of Big Short fame. Guy, I saw something interesting today.
I see what you did there.
You see what I did today?
Brian said that last night on Fast Money. He had no idea.
Saw you. By the way, Brian Sullivan, some of us just call him Sully. You call him Brian.
I don't.
He doesn't like the name Sully, by the way. He has got tremendous music and pop culture, generally movie knowledge, by the way. And we hit some good stuff yesterday. Doug Cass had to straighten me out about a couple of things there, but we did it. Interesting day in the market, guy, for those.
See what happened to Mo Green when he was straightening out Fredo.
Not good. He was doing something two at a time. What was he doing? You can't say
banging cocktail waitresses 2 at a time. The players couldn't get a drink at the bar.
Guy, that's the best line. The players couldn't get a drink at the bar. What do you want me to do? He goes, he's okay, Michael. Sometimes he's Fredo being Fredo. Okay.
You brought it up.
We got a couple things going on here. We're going to talk a little bit about NVIDIA into the print. We're using the Legend today. We'll talk about what the options market is implying. We also, after that huge surge on Friday, we didn't make a new high in the S&P 500. We didn't close at a new high. We're going to talk about a hedge trade idea in the SPY, that is the ETF that tracks the S&P 500. That's going to catch, if we look to September expiration, CPI, PPI, the Fed. Take a look at that. I saw a few interesting tidbits this morning in my morning reading, and I just wanted to pull this up a little bit because I think you also saw it, Guy Adami, and maybe Jacob will pull up our little Canva here. So stock market valuations, we know, is not a good timing tool. This was from Bloomberg. And I think we've seen iterations of this chart. I think Doug has shared these with us. And, people are going to say it's different this time, but look at what we're doing here. Okay, so this is trailing PE, forward PE, CAPE, price to book, price to sales, EV to EBITDA, everything. Throw them all in there. They're taking a little bit of a pastiche evaluation here. You see what's going on in August of 25. It's higher than 1995 or 1999, 1965. You were around back then. I don't know what the hell happened there. In 1929, we had that. What's shocking to me, Guy, is how quickly those valuations get absolutely destroyed when the market starts selling off. Give me your 411 on this.
Well, this goes back obviously 125 or something years, and the periods of time that are highlighted, X 1965. I don't know exactly what's going on. It was probably the beginning of the Vietnam War, if I had to guess, ish or something like that. So, but with all that said, I think we know what happened in the late 1920s, and we obviously, most of us around for what happened in the late 1990s, and we have surpassed those valuations. And the problem that I have is people that know this and yet are trying to explain it away, saying it's somehow different this time. I promise you that if you go back in history at different points, you have the same types of people, not the same people, the same types of people saying same types of things. It's different this time. What I will say, it's never different. And at some point, the math catches up and the valuations catch up. And my concern, as unfounded as it's been, has been that when it catches up this time, it's going to be significant because of how overextended we are. And I'll say this, If you go back in early April, look at how oversold the market got in terms of RSI or whatever metric you want to attach to it. As oversold as we were then, that's how overbought that we are now. The only difference is when things are oversold in the market, everybody is racing to the telephone and racing to the television camera to alert the audience. When things are overbought to the same level, nobody seemingly wants to talk about it because there's some level of normalcy that's attached to markets that go higher. The alarm bells are ringing through this lens. Nobody wants to sort of adhere to them because they haven't had to.
Yeah.
The off in April lasted a week, and then the market was right back on its horse. So people have been rewarded to not pay attention to things that they should be paying attention to.
Yeah, let me drive on the legend here for a second, because to make that point, Guy, about the RSI at the lows in April, and I think obviously you've highlighted this before, but you just see on that downdraft, you know, we had an S&P that was trading at 614, 615 or something like that. In early April, it got down to 481 or something in the index. We know that was 4850. And just look, you see where my cursor is on the RSI. I mean, it was off the board, right? So that was something that if you were pressing those lows at the time, you know, that was not a good place to do it. And you just look at some indications or indicators like the RSI. You know, at the time, Guy, and I remember, you know, when we had that 4850 back to 5800 or something like that, you know, I started to get pretty bearish on what I thought were outcomes for the economy based on the uncertainty of a protracted trade war. Now, it didn't take long, obviously, to get back to that prior high, but it's been a slow grind. And when you look at this bit, you know, back towards, you know, new highs and just this kind of, you know, stair-stepping sort of action, I don't think it's that bullish. I don't think what happened on Friday is that bullish. The question is like when we get to September 17th and we see the Fed, let's call it a hawkish cut. Is that something that the S&P 500 or investors are going to cheer?
Well, you're saying hawkish cut. I mean, I think, again, I mean, it might be. I think that this Federal Reserve last week sort of gave away, and Liz and I had a conversation about it. They sort of have made the decision, and Liz used different language that I use, but the decision that they've made is the job picture now is more important than the inflation picture. And I think what they've told you is they're going to act accordingly. So I'm not certain it will be hawkish. I think it should be to sort of take some of the air out of the sails, but I don't know that it will be. But with that said, again, we've brought this up. I mean, it was this time last year when the market was pricing in 6 rate cuts in 2025. It's 1,000 S&P points ago. And now here we are pricing maybe 2 or 3, and maybe JP Morgan says 4, and yet we're 1,000 points higher, and not a lot has changed. Now, I'll grant you this. Earnings have come in better than expected without question, but they're still historically sort of on the lower end of where we should be. So I think at one point, earnings expectations were like 4.5% growth. We've probably come in twice that or so, but it's still not the 13.5%, 14% that was probably expected. So you understand what I'm saying. A lot of this is multiple expansion, and a lot of it is on the hope that the Fed is going to acquiesce. Yeah, by the way, this is important too, and you can talk and draw at the same time, I know, but I will tell you flat out that we said the market could trade down to an uptrend line, and that's exactly where we stopped. And we thought back in early April that the market would stop there. It did. No. Go back to the other trend line, the longer term one from the lows in, I think, 2020. My point is, like, we thought the market could trend down to those levels. We thought the market would stop there. What we also said, though, at least what I said, the bounce would maybe be 5,700-ish, and then we'd stop. We've obviously overshot that.
Yeah, and before we get to the SPY trade, I just want to hit one more slide. If Jacob wants to pull that up, it's on margin debt, and this is something that you've talked a lot about over the years. And so when I think about this one, I mean, this is kind of off the charts, right? And you look what's going on, and you know, go back to 2020 into 21. We know that there was just a lot of crazy action going on there. It was like free money in the system. People thought they could lever up and take advantage of just what was, you know, whether it was SPACs stocks, or whether it was unprofitable tech, or whatever the hell it was that they were kind of expressing views with, meme stocks and the like here. And we saw how quickly that came in. So here we are. We're at new all-time highs. Why is this important to somebody who doesn't track this data?
Well, this number is going to grow along with the market by definition. So the growth, so the trajectory, it should grow, but not to the extent that this is exponential now in terms of the numbers. So the numbers should be bigger year over year, but not to the extent that they are now. And what it speaks to is it's another way just to examine or illustrate the risk people are willing to take. And in this illustration, it goes out on the risk curve of just being comfortable with margin debt, because you're getting paid to take that risk because the market rewards you on a day-to-day basis. Of course, the problem with this is leverage. This is leverage illustrated in a different way, basically. So you want to understand leverage, you want to look at one slide only, this is it.
Yeah.
Because that's what it is.
Yeah. Worth paying attention to. All right, let's go back to the SPY for a second here, because we talked about some of those levels. We talked about the oversold condition that we had in April. We talked about the the overbought situation that we're getting in now. This is a chart I kind of marked up earlier, Guy, and I just want to kind of highlight why did I start that trend line where I did in late April? I did it because that was the day of the push out of the Chinese tariffs, and you saw that big gap, right? You almost saw, a trade back to that uptrend. Now, the uptrend didn't mean anything back then, but it bounced off that 200-day moving average, and you saw this kind of series of higher lows and higher highs, right? And then there's that other gap right there that you see from, I think that was in early June. It was another push out of tariffs. So we've had that situation. I think the taco trade, to be honest with you, is kind of done now. That's the the always chicken out sort of thing. But we do have those gaps, and they're kind of unfilled at this point, to say the least, right? And so I'm looking at the breakout level to new highs. We talked about that. That was about 615. Below that, around 600, right, is that unfilled gap. You see that 200-day moving average rising. You also see where that uptrend is, and we kind of bounced off it on two situations or two instances over the last, call it, month or so. So I'm looking at this and I'm saying to myself, okay, let's think about September expiration. Let's think about what we have. Mid-month, we have CPI and PPI. Those have been things that the market has rallied off of. Now I want to go to a chart we put together. This is of implied volatility, the price of options. That's the blue line. And then if you looked at realized volatility, that's the white line. That's how much on a 30-day basis we've seen movement, okay, the white line, and then what the options market is implying. When they come together like that, it's basically telling you the blue line, implied volatility, what you're paying for options is kind of cheap, right? So now I want to go to the legend for a second here, and I want to kind of price out what the implied movement is between now and September expiration, which is going to catch those events, right? So if I'm looking at this right here, I can look at all these different expiries on the left, okay? And I go to September 19th. The button here down on the bottom will bring me right to the at the money, right? So we're trading right now at 642.5, let's just call it. So let's just say I want to look at the 643. So that put in September expiration is offered at 770. Okay, the call, because we're in the money here, is at 8.5. So the implied movement is $16. Okay, between now and September expiration. So let's call it $8 a side right there. If you're trading at 642.5. $8, that is just a little above 1% if you're looking to buy an at the money call or buy the at the money put if you're looking to express some sort of view. That seems pretty cheap, Guy, when you consider how much the market has been moving of late, or particularly on Friday. And I know that we've seen vol kind of tamp down since then. When you look at a $16 implied move in either direction between now and September, cheap or expensive to you?
I think it's cheap. I think you just hit the nail on the head. You're taking, well, if you were to embark upon this, you're taking an advantage of a VIX that's now either side of 15. Again, this has been this is in the lower levels, the lower band that we've seen over the last year and a half or so. And if you have the belief that I'm of, and it doesn't appear as I'm going to be right, because I want to, I want to be as transparent as possible. I thought a week or so ago that you'd see 25 in the VIX by the end of August. Today's August 26th. So doesn't appear that's happening. But I do think there's a volatility event in our horizon. So by doing this, you're taking advantage of a VIX that's been depressed for a number of different reasons. I think one of the main reasons over the last sort of death knell for the VIX came in the form of the Fed on Friday and some of the commentary that we heard. And the market is saying, wait a second, the Fed has just told us that volatility is not going to be a thing because they have our backs in the form of rate cuts. I don't adhere to that, but I think that's what the market is saying. So to answer your question, I do think it's cheap in this environment, especially with all the catalysts you have coming up in between now and expiry.
Yeah. So I want to look at a put spread. You could think about this as a hedge for an existing portfolio that you have. You could look at it as an outright bearish bet. And I'm going to do something that, Guy, you're probably going to disagree with just a little bit. I want to do a put spread. I want to buy the near the money put, and I want to sell an out of the money put. And one of the reasons I want to do that is I want to create this spread. I want to kind of really clearly define my risk. And I like round numbers too. So I'll just show you what I'm doing here. So we're 642.5. I'm going to look at the 640 put, and I'm going to look all the way down there at 610. One of the reasons I'm looking at 610, because we just highlighted the fact that we have that unfilled gap, and that's where we are back then. So if you look at this put spread, if I'm buying the 640 put in September, I'm selling the 610. So I'm paying 660 for the at the money, and I'm near the money, and I'm selling that all the way down there at $1.74. Okay, so that's just call that $5, right? Let's pull up the screen that we created for a payout diagram right there. So if I'm paying $5 for the 640, 610 put spread in September expiration, I can only lose that $5, right? So if you think about it, I'm paying 640 and I'm selling 610, I can only lose that $5. It breaks even at 635, but I have gains up to $25 down all the way to 610. And you might say to yourself, let's go back to the legend for a second here. You might say to yourself, well, why would you do that, Dan? Why would you kind of cap your gains down there at 610, and especially when you're getting less than, I don't know, 0.5%? Well, I'm going to look at the delta here. So a delta is basically suggesting what the probability of this option being in the money. Okay, so right here, if you look at this far right column, it's basically a 12 delta. Okay, now generally a rule of thumb is don't sell options below a 10 delta, but a 12 delta right here is saying there's about a 12% probability that put is going to be in the money on September expiration. And again, I just said I'm trying to kind of line this thing up a little bit. I know it's going to be the dog days of summer as we get into Labor Day weekend, this weekend, that sort of thing. So maybe you see a slight offset, right, in decay of the put that you're buying. But I like the risk reward here. I like paying 5. I like the fact that I'm breaking even down a little more than 2% at that 635 level or so. And I like the potential of risking 5 to possibly make 25 if we have a pullback of 5.5%.
5 to 1 risk reward makes sense. That delta is skewed, I think, because of where the VIX is. I think if you were to think about it through a different lens, I think that's probably higher. Like I would probably have it somewhere closer to 20%. Just thinking about it, not the math behind it. So yeah, I think you make that play, understanding that again, got a long weekend, so there's this vol decay that takes place, but you also have a lot of catalysts in between, and those catalysts are not being priced in because of the complacency of the market now, thinking there's some Fed put in place. And I think that's, I'll say this, it's clearly not taking into consideration, and this is not politics. I mean, what we heard last night in terms of, attempting to fire a Fed official for cause, which has never happened before. And, that is, to me, I think it changes the playing field a little bit. And Liz and I had a conversation not about that, but tangential to that in terms of what's going on with Intel and the government taking a stake in Intel and all the different things that are happening now that a 15 vol does not, it's, in my opinion, is not pricing in.
Yeah, and I want to, on the Fed president thing, I think her name is Cook. I know her name is Cook. I mean, really, there's a couple ways to think about this, right? So the White House has been all over Fed Chair Powell, all of his surrogates, right, as far as it relates from Bessent and Treasurer and a whole host of other folks here, Kevin Hassett and stuff like that. They want him to lower rates, and they want to lower rates aggressively. They're also threatening to sue the Fed on the overruns and costs about the construction of the, that sort of thing. So now they're coming off after a Fed president. I want to go to Peter Bookvar's note. This is the book report. And let's scroll down a little bit, because this is something I think is really interesting here. So let's just look at this right here. So this is Peter not being political, okay? Lisa Cook was likely targeted, I'm sure, among others, and then disposed of without due process. I think this is the really important part here, okay? So if there is wrongdoing, there's wrongdoing. But everybody in our country, in our democracy, deserves due process, right? Like, so if someone is threatened, or somebody is, suggested that they've done something illegal, I mean, it's not the common case here to just fire that person if it's in a corporate sector. I mean, there might in a private sector, there might be rules about this sort of stuff. But as it relates to a situation like this, they're deserved of due process, right? And so who knows? And so the other point, that Peter's making, while she was in the Fed or in her Fed seat, and whether she ultimately leaves or not, in order to remake the Fed with people who will most likely be inclined to cut interest rates. And this speaks to the point about the independence of the Fed, right? So if this happens, someone's put in place and that person becomes a very, very vocal, somebody who wants these rate cuts, then you have to start to call that in question. And your point, I think, to some degree, is does the market, whether it's be the US dollar or whether it's the bond market, do they call bullshit on this sort of stuff?
Yeah.
Probably not immediately, but I just think this is worth a discussion.
Well, that's what listen. Yes, again, you're right about the due process, and I have no idea if she broke the law or not. I have no clue. I've not read enough about it. But what I will say is, this is problematic for a number of different reasons, and the Intel thing plays into this. Again, you want to create a sovereign wealth fund. That's as you would say, you love the saying, "Have at it, have at it." I mean, there are ways to do that, but in terms of Intel, and I'll try to connect the dots, on August 6th or August 7th, the CEO of Intel, according to President Trump, was compromised by the Chinese, either military or government, which is one and the same thing. And he was telling him he needed to step down immediately. 2 weeks later, he's at the White House, and now they have the U.S. government taking a stake in Intel. So what it appears to be going on to me is, you threaten people, you have them come up to the White House, and then theoretically, you get better terms on whatever deal you're looking to make from that person for self-preservation. I mean, there's a lot that's absolutely going on. So the next question is, and President Trump addressed this, he said he hopes this is the beginning of many. Now, if I'm watching this from afar, it doesn't give you a lot of confidence into the system of capitalism, that there's a reason why we have the most robust capital markets in the world. I mean, it's built on something, but if those building blocks are sort of chipped away, then that speaks to a confidence game. A confidence game is the bond market. What's going to happen to corporate bonds? What's going to happen to government bonds? And this is against a backdrop, by the way, of global bond yields going higher. So just me, and I'm not suggesting I'm right, but this is not bullish for bond markets at all. There's no way to say, you can say it's not bearish. Okay, it's certainly not bullish.
Yeah, I agree. And the interesting thing about this is, like, when does the bond market, when do investors call bullshit on it? Because it might come at an inopportune time. I just want to spend a minute on Intel, because we talked about it last night on Fast Money. And I think this is, something worth noting here. Okay, so yeah, the CEO of Intel, he gets called out. He hasn't been there very long, less than a year, right? And if he's only being called out because you think that he's compromised, that's fine. You know what I mean? But again, without due process, without some sort of evidence that this individual who's been in the United States, he's been a CEO of other publicly traded companies, he's been vetted by boards, he's probably been vetted by the government. If you think about it, if you have that many government contracts, or at least the businesses, okay? So you think about this company, and they own the markets in CPUs. These are the things that go in a lot of electronics, whether it's laptops or desktops or servers that go into data centers, that sort of thing. But they're not the GPUs. They're not the ones that NVIDIA and AMD are making for the training of large language models. This is the big problem. This is why this company has lost market share, generally across almost every sort of product that they're involved in. But okay, if you think about this, they've spent over $100 billion in CapEx, I think, over the last kind of 5 to 7 years or something like that. The market cap of this company, guy, is $107 billion. They're expected to have $53 billion, $52 billion in sales this year. That's down from $80 billion in sales. That just speaks to the sort of market share that they're losing. $79 billion in revenue back in 2021. So when you think about the government making an investment in it, it's not a bailout. I mean, in some ways, fantastic, but this is over $10 billion in CHIPS Act funding. You know what I mean? So they can create manufacturing capabilities here in the US. It's just not going to happen with $10 billion. So the government's going to continue to take more and more, equity stakes just to kind of try to resuscitate this company. It doesn't make a lot of sense, in my opinion. And it's not really letting capitalism, free market capitalism, do its thing. It's picking winners and losers. And if that's going to start to be the case here in the United States in our capital markets, then it's going to be another confidence game, right? If these are going to turn into state-owned enterprises. And the last thing I'll say about this, because we talked about the idea of a sovereign wealth fund. Sovereign wealth funds invest in things that they think have great prospects, right? This is not the case with Intel, right? This is if the government was investing in NVIDIA a year and a half ago because they thought GPUs were going to be the thing that, is going to be transformative in generative AI, well, that would make sense. And I'll bet you Norges, which is Norway, which is one of the biggest sovereign wealth funds, go look at their holdings right now. They're invested in some of the, the best performing equities. So I just want to be really clear about this. This is not that sort of strategy.
No, I'm not suggesting it. Again, this is some, there's chat about sovereign wealth fund. I asked Megan Casella last night, is this sort of the beginnings of, or what appears to be, but it's much different in terms, like the ways to do the Swiss probably, in my opinion, probably the gold standard for it, whether you like it or not, in terms of what they've done. And there's a reason why their bond yields have been going lower. And there's a reason why, and the reason why is because they run their country probably better than other. Their debt to their debt is 37%, I think, of GDP. By contrast, the United States is probably approaching 122% or so debt to GDP. So, they're getting rewarded for it, the Swiss, and we're not. And they do things a little bit. I'm not saying, well, in this case, I am saying a little bit better. So, but that to me is sort of the level of, that's what you want to aspire towards, not this. And I'll use the term. I mean, there's a strong army. And then you have to wonder, okay, now that the government has this stake in Intel, are they going to browbeat people into participating or dealing with or buying from, or whatever word you want to use, from Intel? So, what are the knock-on effects of this? And again, it's all built on confidence. And if the market senses a lack of discipline or a lack of confidence, we're going to be penalized for it in the form of our bond market. And it doesn't appear that way today. I get it, but this is how it starts, in my opinion.
Yeah. So just to be really clear on this, and maybe Jacob can find out the number of Norges, Norges, their sovereign wealth fund. So their top 10 holdings, guy, are not going to surprise you. NVIDIA is their largest holding, 3.5%. Microsoft, 3.5%. Apple, Alphabet, Amazon, Meta, Broadcom, Taiwan Semi, Tesla, and then Berkshire and JP Morgan. Okay. So you see what's going on here. Like, they could just buy the S&P, or, you know what I'm saying? Like, it would probably be a lot easier for them, but you'd say to yourself, okay, well, they don't actually have, this sort of shareholder, opportunities as it relates to, a voice and that sort of thing. But this is what one of the largest sovereign wealth fund owns. They don't own crap like Intel, right? And so that it could be semantics. I'm just bringing that up because you know what I mean. Like, they can call it whatever they want, but in America, like, it's really different. I mean, these guys are investing in companies in the public markets. What the United States government is doing in this situation is taking an equity stake for certain reasons. That's very different than buying the stock in the public markets. Is that fair?
It's fair. And again, what is it? What is this the beginning of? Who is the next? Look, again, and we don't want to take too much time on this, but if you think about how this played out, again, in early August, this, according to the administration, was a CEO that was basically a Chinese operative, and he needed to step down. 2 weeks, 3 weeks later, he's at the White House, and they're formulating a deal. I mean, the pendulum can't swing much further left to right than it swung in terms of this. And he said yesterday, President Trump, he hopes there are more deals like that. What does that mean? So who's out there trying to drum up some dirt on some existing CEO that they can somehow use to their advantage to get a favorable deal? Because I guarantee you that's what's going on. And then who's next to then get summoned to or show up at the White House? And what does that look like? And again, it all comes down to the self-preservation of these individuals. What was promised by the Intel CEO to the, I mean, there's so many things that are yet to be sort of exposed here, but in my opinion, none of it's particularly good. And that's not Republican Democrat. I mean, that's just sort of the foundations of capitalism that I think we're sort of encroaching upon.
Yeah, no doubt. I mean, listen, if this was, another administration of another party, I mean, I'm sure, there'd be screaming on both sides about this.
But by the way, I mean, the Biden administration put certain parameters around the CHIPS Act stuff in terms of if you want to get money, this is the requirements. That was equally shitty.
No, I mean,
but
God, the main requirement is that they use it to build out manufacturing in the United States.
No, there were DEI requirements around it. I mean,
that's fine.
So,
I mean, there's been a reckoning for that. Biden administration, or come on, they lost an election because of that.
But point is,
but
the
point is
swings both ways.
Yeah, I mean, I think it's very different here. I mean, they weren't taking a stake for something that
no, they were not. But again, you understand what I'm saying. I
Correct.
mean, this is pushed out a little bit more, but they both suck.
Okay, so fine. But I disagree. NVIDIA.
Well, I don't know how you can disagree with that. I mean, it's just factually true. They put stipulations on it. I mean, that's factually true.
Okay, but like politics is a thing of compromise, right? And to get that money out the door, and it's shareholder money, there was a certain, contingency in the Democratic Party that made that happen. But they got to enact, we all can agree. I mean, the fact that this current administration does not agree with the CHIPS Act, or they're trying to pull the money back. That was one of the first things they tried to do. And now they're doing this deal. You know what I mean? So they can actually get manufacturing back going. It's the same shit, man. It was just politics. You know what I mean?
You're making my point for me.
Oh, I'm not. I'm not really, because we didn't take a stake. Like the Biden administration didn't take a stake. Well, let's go to NVIDIA, because this is one that you and I've talked a lot about. Okay, it's exactly what you talked about. Jensen Huang, I don't know if it was preservation of his job. He's one of the richest men in the world now. I mean, he could buy, whatever. The point here is he had to go to the White House. He had to go to Mar-a-Lago. He had to follow the president around in Saudi Arabia. And then now he has to pay a VIG on what, on high-end GPUs that are sold to China. So that's not too different here. So they report tomorrow night after the close. If you're just, let me go back to the legend here for a second. Okay. So let's just go to the options chain here. I want to start with September, because I think this is kind of interesting, guy. So if we go, the stock is trading right now at about $181, right? So if I just go to let's say the 180, so I see the at the money straddle here, right? You see what that's trading at, about $17. You can eyeball that. Well, if we're trading at 181, that's just about 10%, right, of the stock price. So implying about a 10% move between now and September expiration. Okay, so they report tomorrow night after the close. Let's go to August 29th expiration. That's this Friday. Again, we said 181. If you look at the at the money straddle, let's see, you get basically $11. Okay, $11 divided by 180 gives you, what is that, 6% or something like that? Okay, we've been talking about that. That's the implied movement. So let's just say you're bearish, or you want to hedge an NVIDIA position, and you're willing to pay 540 or 545 or something like that for the 180 put. Your break even, okay, down there, it's at 174.55. Does that sound right? So it's the premium less the strike, gets you the break even down there. That would be about 3% in either direction. So the implied move, 6.5%, 6% or something like that. Are you willing to risk over 2.5 trading days, or 3 trading days right now, that 3% to hedge your position? I don't know. I mean, if you're long the stock, and the stock right now has had these, this year it's up 35%. Last year was up 180% or something like that. Does that seem like a decent, good risk reward? It's binary, right? If you're a penny below that 180 strike on Friday afternoon, you lose all the money.
It's a tough one, because we have seen over the last couple of earnings releases that it's not an an immediate move, but it does move in the aftermath. So whether it's 2, 3, 4 days is when things start going. So you're making the bet that it's going to be a window of opportunity here. Now, given where the stock is trading, maybe it's a bet worth taking. I happen to think that it is, given where we are and given some of the enthusiasm around it. So it makes sense to me. Now, you just said it. It's a very short window of time, but go back over the last couple earnings releases. I mean, go back in I think it was January when the company reported. I think it traded up to I want to say 153 or something. I might be off by a little bit, and then subsequently cratered. So we've seen significant moves on the back end of earnings before. Sometimes it's taken a little bit longer, but I think given the extension we've seen in the name, this might take place a little bit shorter. So I think this is a bet it's worth taking.
Yeah, I mean, if you're long the stock and you're kind of worried about, I mean, there's a couple things going on here. There's China sales, the idea of like turning on production on these H20 chips to sell to China. It wasn't kind of an easy thing. Supposedly the Chinese were basically suggesting in a nice little way to, Chinese companies not to buy the chips after some, back and forth, I guess, with Treasury Secretary Lutnick. So the China, I guess there's a ban on one side, there's a ban on the other side. One guy gets to pay a vig and they get to sell it, but they've actually pulled back, I guess, on production. That was kind of the word over the, I know what you're going to do there. One guy does this way, one guy does the other way. What do you want from me? What do you want from me, Guy?
No,
why is Eli Lilly up 4% today?
They had an announcement today about the oral 20. I think people lost 22.5%. Like 22.5%. I think was the number, and it came in line a little bit better than expected. So the market's getting a pop on the back of that.
What's Viking doing? I just see a headline there because they were working on an oral, right?
I haven't looked at Viking, but give me a second.
There, guy? What is
VKNG? VKTX. Sorry, is Viking Therapeutics. I think it's probably trading like 25 and change if I had to guess. Yep, there you go.
Trading 25.40 right now, so it's down.
Yeah. So it ran up to about $42. Then it cratered. On the back of, similar news, they had obviously a disappointing news, and now it's sort of found a home. I think it traded down to this is Viking now. I think it traded down to it didn't get down to the April lows, but it got close. So again, this is a $3 billion company, Viking. We've talked about it before. Gerald Holtz has been on the show. He doesn't think as much as an acquisition target now that it may have been. I'm not certain that's the case, but this is one in the same space I think is worth looking at.
Yeah. One last thing, I want to hit on tech. These enterprise software stocks continue to suck. I mean, Salesforce is down 9%. It's down nearly 30% of the year. Adobe is down 2.5% today. It's down 20% of the year. The Adobe has not sniffed its all-time high from 20.
Bounce.
It's crazy. Workday. Okay, it's down 1%. It's down 13% of the year. ServiceNow is down 11% on the year. It's down 2.5% today. HubSpot is down 33% in the year. Twilio is down to, Monday is down to, these names can't get out of their own way. And I know that there's a lot of analysts on the street who cover this sector. Very few are bearish on the prospects of a lot of these SaaS names because they're just not worried right now about agentic AI and what's going to do for these models and the like. And I just think it's interesting that we're in a raging bull market, right? And really an important group over the last 5 years or so prior to this kind of Gen AI thing, they can't get off the mat.
So Salesforce, if you want, there it is there. I said a couple weeks ago that I thought that 235 low-ish was going to hold, and I thought it could bounce from there. And I said that because if you go back and look, 235 was the low-ish that we saw in April. We traded down there, I want to say in the beginning of August, and then we started to bounce. And it looked like I might be onto something, but it's basically run into this downtrend line that's been in place since probably the beginning of the year. And to your point, none of them bounce. Here's one that it just came to me when you started talking about these names, and we can end the show on this, but the government, somebody's going to walk into the Oval Office and say, hey, did you know there's a company called Snowflake that hasn't been trading particularly well. And I guarantee you, at some point, the government's going to take a stake and force them to change their name and say the reason why you've been trading is poorly. And you laugh, but don't think that somebody isn't thinking about this. In the world we live in, it's not that preposterous. So this is one that I think you want to start to watch too.
Guy, I've always thought your mind works in mysterious ways, but that's a new one, man. I didn't even think
Not
about
crazy.
that. All
You're
right, man.
telling me that there's a company called Snowflake? What the hell do they do? You know that's going to be a conversation that's going to, and when it happens, I'm going to have, what do they call it when you laugh out loud?
LOL, laugh out loud. Yeah. All right. Well, tomorrow will be a big day. After the close, we have NVIDIA reporting. I think we surrounded that trade. I think the Intel thing is fascinating. It'll be interesting to see what happens, Guy, when they shit the bed on the next quarter. You know what I mean? What the commentary is going to be like. And, you know, the stock has been in that range. What is it, 20 to 25? It's near that 25 range. So let's just say, you know, investors just kind of lose hope in this sort of thing, and it finally breaks that 20. It will be interesting. That's kind of the point that I think both of us are making. When you start making these investments in the company, do you start acting like a shareholder? Because some shareholders, when a company, you know, shits the bed and guides lower and all this sort of stuff, they sell. You know what I mean? So if these guys are never going to sell, you know, listen, $10 billion is a rounding error. Throw it on the heap of debt that we have. You know what I mean? Like, it's just kind of an interesting one where it's going to take a lot of capital to turn this thing around. And the point I made last night is, like, technology companies, they're always in battle for talent, right? What sort of talent is going to go work at Intel when an administration starts taking stakes in it? They're just not going to do it. So good luck with that. I'm sad because this is a great American company, but this is not. This could be like the death rattle for them. So
have at it, people. That's what you say.
Have a ball. All right, man. That was good. We have Peter Bookvar and myself tomorrow dropping in the Risk Reversal podcast feed. If you haven't listened to Guy and Liz yet, it's in your favorite podcast store. That would be Liz Thomas from SoFi. Who else do we have at the end of the week? I think we have Rebecca Patterson.
Patterson this week.
Bridgewater. So that'll be kind of exciting too. So, you know, stick around, listen to the content, watch the content. All right. See you guys. Thanks.